Good day, grade 10s. We have to do adjustments for the next week and a half. I know we've done adjustments during the lockdown, but I would like to redo this so that you can actually hear it in my voice. So the first adjustment we're going to do is depreciation. Before we do depreciation, you need to know why there is something called depreciation. Depreciation is the decrease in the value of your vehicles and equipment. Remember, as we in our business use the vehicles and the equipment, the value of those assets are going to decrease. Depreciation is only calculated on vehicles and equipment and not on land and buildings, because in real life, land and buildings, they really don't depreciate in value, it actually appreciates. But that's not part of the CAPS document. Those of you who are going to do accounting after school, you will learn about appreciation. So we just have to do depreciation on vehicles and equipment. The next thing that you need to know is that there are two ways to calculate the depreciation. The one is called on cost price, which is a fixed amount every year. And the second way of calculating the depreciation is on the diminished balance or the carrying value. We're going to use a simple exercise to explain the difference between the two methods of calculation. So what is the calculation on cost price? The formula is very easy. It is the cost price of the vehicles or equipment times the depreciation rate, which will be a percentage, times the period of depreciation, which normally is a year if you have that vehicle or that equipment for the full accounting year. On the diminished balance, the calculation for depreciation is going to be, you first need to take your asset, which can be vehicles or equipment, and then you minus all the previous depreciation on that asset. The diminished balance means you are diminishing the cost price or the balance of your asset, then again times the depreciation rate times the period. So those are the two formulas, right? So we now have to write off depreciation on vehicles. Before we do the writing off the depreciation, I want to explain the new accounts. You know that vehicles are an asset. An asset has a debit balance. You know that. Equipment is an asset, so equipment will also have a debit balance. Accumulated depreciation on vehicles and accumulated depreciation on equipment can obviously not be an asset, because assets are possessions of the business. It's not liabilities either, because a liability is money that the business owes to another person or to another business or institution. So these are not assets, they are also not liabilities. What they are negative assets. So let me write negative assets. I'm writing with my mouse, which is not very easy to do. They are called negative assets. What is a negative asset? A negative asset is an asset that decreases, or is an amount that decreases the value of a specific asset. So accumulated depreciation will decrease the value of vehicles. Accumulated depreciation on equipment will decrease the value of equipment. Because they are negative assets, their balances will be credit balances. In the CAPS document, in school accounting, there are 3 negative assets. The first two you are doing now, accumulated depreciation on vehicles, which is a negative asset decreasing the value of another specific asset called vehicles. And accumulated depreciation on equipment is a negative asset, which will decrease the value of a specific other asset, equipment. The other one you're going to do second term in grade 11. Now we can go to the adjustment. 20% per year on the cost price of vehicles. So let's do the calculation first. Cost price method says take the cost price. There's the cost price. How do I know it's the cost price? It was written over there. times what was the rate? 20% times 20% for a year gives you 30,000. So we now know that the depreciation on vehicles, I'm going to write DPR on vehicles, for the past year is 30,000. Depreciation is a new account for us. Depreciation, what we've calculated, is an imputed. Imputed means calculated. It's not money you are going to pay anybody. It's an imputed expense. I'm still writing with my mouse. Because it is an expense, you will debit depreciation. So in your general journal, depreciation will be debited 30,000 and accumulated depreciation on vehicles, which is a negative asset, and the depreciation are actually increasing the total depreciation, will be credited. Don't forget, you need to have a journal narration, and the narration explains what you've done. You've provided for depreciation on vehicles at 20% per year on the cost price. Right now we have to post to the general ledger. The three accounts concerned is obviously vehicles, accumulated depreciation on vehicles, and depreciation. You will only write in the vehicles when we buy new vehicles. Ooh, the mouse is difficult to use. Or when you sell, or the owner takes, but you're never going to sell in grade 10. So we will only write in vehicles when we buy new. This is the plus side. And when we sell the vehicle, you'll write on the credit side. Accumulated depreciation, which is your new account, negative asset, has a credit balance. The general journal said accumulated depreciation on vehicles must be credited in the credit side. There we go. 30,000. We saw this in general journal 1. The other account concerned was depreciation. In the general journal, we said depreciation must be debited. Depreciation new account, it is an imputed expense. Let me just write again. Imputed means calculated expense. I'm just going to write EXP for expense because it's not so easy to write with the mouse. They told us that depreciation must be debited. There in the debit column, depreciation debit. Name of the other account concerned was accumulated depreciation. You saw this in general journaling 1. Folio column was posted to account N14, was posted to account B11. Next transaction. Provide for depreciation 10% per year on the diminished balance of equipment. Diminished balance means take the balance. Diminished means take the balance and decrease it first. How do I work? What was the balance in vehicle and equipment? 58,000. So there is the 58,000. Diminished with what? With the accumulated depreciation. There's the accumulated depreciation. And then calculate the 10%. Journal entry stays the same. Your expense depreciation will be debited and accumulated depreciation on equipment will be credited. Your narration, provide for depreciation on equipment at 10% per year on the diminished balance. When you post, will not write in the equipment because you only write in equipment when we buy new, if we buy new, or when we sell. Right. Accumulated depreciation on equipment, negative asset. We said credit accumulated depreciation on equipment. There it's been credited. The other account concerned was depreciation. And then debit depreciation, which we have done. On the debit side, we have an account. There is the debit entry. Right, let's go to the next slide. You know, at the end of the year, all balance sheet accounts must be totaled, so we will have to total these two accounts. By totaling, you only need to total because there are entries on one side only, so you will have a total. You do not need to balance. Then all nominal accounts must be closed off at the end of the year. Why? Because the nominal section has all income and expense accounts. And those accounts are used to determine the profit or the loss made by the business. What is the formula for profit? It's your income minus your expenses. That calculation, remember we are doing accounting, so the calculation of your profit will be done inside accounts. And the two accounts are called the trading account, where you will calculate your gross profit, and the profit and loss account, where you calculate your net profit. How do you calculate gross profit? Gross profit is your net sales minus your cost of sales. What is net sales? Net sales is sales minus debtors allowances. And as soon as you've done your gross profit, from gross profit, you go to net profit. Net profit is your gross profit, which you've just calculated, plus all other incomes minus all other expenses. Nominal accounts must be closed off at the end of the year. So what do we know about the depreciation account? We know it's a nominal account. We also know it is an imputed expense. And we know that expenses goes to profit and loss. Because depreciation is an expense, and expense will be closed off to your profit and loss account. So how do I close it off? This is my depreciation. I'm going to total. This is my total depreciation. Must be closed off to profit and loss. How do I close off? By writing on the opposite side. I'm going to transfer this amount to profit and loss, and I need to total as well. Right, that's the story for depreciation. I am going to let you do an exercise from the textbook, but that will be in your post. You keep well and stay safe.